Hello financial fans, welcome back to another stock analysis. Today we'll be covering VICI Properties stock ticker VICI. VICI Properties is a real estate investment trust, or REIT, that specializes in owning and leasing gaming, hospitality and entertainment properties. Essentially, VICI Properties acquires ownership of the land and buildings that house casinos, resorts and other entertainment venues, and then lease them out to the operators of those properties. The company was formed in 2017 as a spin-off from Caesars Entertainment Corporation, and it currently owns a portfolio of more than 30 properties across the United States, including the iconic Caesars Palace Las Vegas and Harrah's New Orleans. VICI Properties tenants include some of the biggest names in the gaming and hospitality industries, such as Penn National Gaming, Hard Rock International, and MGM Resorts International. By leasing its properties to well-established and reputable tenants, VICI Properties aims to generate stable and predictable rental income for its investors. Additionally, the company seeks to grow its portfolio by acquiring additional properties that meet its investment criteria, as well as by expanding its relationships with existing tenants. Additionally, the company seeks to grow its portfolio by acquiring additional properties that meet its investment criteria, as well as by expanding its relationships with existing tenants. They are currently sitting at a $31.8 billion market cap, and in 2022 they generated a revenue of $2.6 billion, and the dividend yield is currently sitting at a nice 4.92%. 78% of their revenue comes from financing leases, 18% from receivables and loans, 2% from others, and 2% from golf revenue. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health and the growth of the company. I will be using a standard margin of safety of 25%, that can never be below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction for a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, gone from $43 million in 2017 to $1.6 billion in 2022. The average EBIT growth is 255.7%, meaning a 10% deduction in the margin of safety. The margin has also gone up significantly, going from 21.39% to 64.58%. This is a 40.6% average margin increase, which is a 5% deduction in the margin of safety. The next two ratios are the dividend growth and the debt to EBITDA. The dividends have gone up over the years as well, going from $1.15 a share in 2018 to $1.56 a share in 2022. The average dividend growth is 8%, meaning a 5% deduction in the margin of safety. The debt to EBITDA is calculated as follows. You take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Of this, you get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for VICI, this is over 8 years, in this case a 841% debt to EBITDA ratio, which is insanely high. This gives that a 5% increase in the margin of safety. The final ratios that we're going to look at are the occupancy rate and the rent reversion rate. The occupancy rate stands for the amount of property that they own that is currently occupied. In this case, they have an occupancy ratio of 95%, meaning that only 5% of their property is vacant. This gives them another 5% deduction in the margin of safety. The next ratio was the rent reversion rate, and the rent reversion is when a landlord raises the rent on a property when its lease is up for renewal to match the current market rates. Basically meaning they're making more rent out of their properties. And their 5-year CAGR of their rent from property was sitting at 3.2%, which is no change in the margin of safety, as you can see in the bottom. It's looking very good so far for VICI Properties. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the price to funds from operations, comparing the price to funds from operation ratio of the past 5 years to the trailing 12 months price from funds from operation. In this case, I've only been able to get the price, the AFFO per share rather, of the past 2 years. And on average, this one has been sitting at $20.58. Doing the same for the trailing 12 month, we get a price to FFO of $24.44. This gives them an intrinsic value out of this model of $26.76. And that gives them a 15.77% downside out of this model. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of VICI going from 2018 to 2022. The average growth rate in the dividends during this period was 7.96%, and I'm projecting expected growth rate in all of their future dividends of 4%. I will be using a discount rate of 9% in this valuation, giving them a dividend discount model price per share of $32.45, which is a 2.13% upside out of this model. The third model that we'll be using is the AFFO multiple valuation. In this model, we look at similar companies to VICI and look at their price to AFFO multiple. In this case, the average in the industry is sitting at 18, while the one of VICI is sitting at 16.51. That gives them a intrinsic value out of this model of $34.62, which is a 8.99% upside out of this model. And the last model that we'll be using is the net asset value. In this model, we take a look at the net operating income of VICI, and we project a growth rate estimate for the forward-year net operating income. And then we determine the capitalization rate on this net operating income. In this case, I've gone with 3%, giving them a value of $42 billion. Then we have to subtract the total debt, and we get a net asset value of $27.5 billion. Dividing that by the amount of shares outstanding gives us the net asset value per share, which is $27.45. Which is a 13.6% downside out of this model. If you want to get access to all of the models that I use in my videos and way more, you can check in the description for my Patreon link. Anyways, getting that self-promotion out of the way, let's go look at the final overview of a valuation next. Looking at the final overview, we've imported the price to FFO, the discounted dividend, AFFO multiples, and the net asset value price per share, giving us an average of $30.32. A margin of safety we've determined earlier, using a standard margin of safety of 25%, deducting by 10% for the EBITDA growth, 5% for the margin growth, 5% for the dividend growth, adding 5% for the debt to EBITDA, and deducting another 5% for the occupancy rate, giving us a 5% margin of safety. Applying this margin of safety, we get a fair value of $28.88, and with the current price of $31.77, we get a small downside of 9.1%, indicating that's currently a moderate sell. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.